What if I told you the biggest shift in Australia's property market this month wasn't prices? It was buyer behavior. Because while most people are still arguing over whether prices will rise or fall, the latest data shows us something underneath the surface that has started changing. And if you're an investor, you need to understand what it means before the headlines catch up. You see, over the last 28 days, we've had fresh updates from CoreLogic, Totality, REA, auction market data, construction industry reports, and the broader economic releases. And when you connect them together, they paint a very different picture to what the mainstream media is. Because yes, national property prices are still rising, but demand is slowing. Confidence is softening, supply pressures are worsening, and the market is becoming far more selective. And the most part, most people look at these headlines individually, when the real insight comes from understanding how they're all connected. So later in this video, I'm going to show you the contradiction happening right now in the Australian property market. Why prices are still climbing despite worsening affordability, rising rates, and weaker auction results. And why that contradiction could shape the rest of 2026. But first, let's start with the biggest immediate pressure point, borrowing power. Over the last month, the Reserve Bank's March hike pushed the cash rate up to 4.1%, making the second consecutive increase after Feb. That matters because mortgage rates are sitting broadly in the mid 6 to 7%, and future markets are still pricing the possibility of a further tightening this year. Now, why does this matter? Because high rates don't just impact repayments, they reduce borrowing capacity. And when borrowing capacity falls, buyers don't disappear overnight. They become more cautious. That's exactly what we're seeing now. REA reported this week that housing market activity is beginning to slow, with analysts noting that the impact of consecutive rate rises is now filtering into buyers and transaction behavior. So demand, it hasn't collapsed, but it has clearly become more selective. This means buyers are active, but they're far less aggressive. And you can see that immediately in the auction data. Australia's national auction clearance rate dropped to 55.5% this week. It's the lowest point since 2022. That's a meaningful change. Now, why is that? Because clearance rates are one of the fastest leading indicators of demand. They show us buyer confidence before price data does. If clearance rates weaken first, price often responds later. And what's interesting is the softness isn't uniform. Sydney and Melbourne are showing the most weakness, while smaller capitals remain relatively resilient. That tells us it's not a national downturn. It's affordability-sensitive markets reacting first. And that makes sense because Sydney and Melbourne buyers are already stretched further than almost anywhere else. So when borrowing power gets hit again, those markets feel it first. But here's where it gets interesting. Despite softer buyer demand, prices are still rising nationally. According to the latest March data, Australia's national dwelling values rose 0.7% for the month, taking the total of Q1 growth to 2.1%. So how can prices still be climbing if demand is slowing? Well, simple, supply. Because while demand has softened, supply has not improved enough to offset it. And that's becoming one of the defining stories of this market. See, fresh construction commentary this month showed Australia's housing pipeline remained under major pressure. New South Wales completed only 44,900 dwellings in 2025. That's down 1% from the prior year and well below the required housing targets. Industry groups are now warning New South Wales alone could fall 150,000 homes short of its 5-year housing targets if this current trend continues. And it gets worse. Construction leaders are now warning rising fuel material costs are putting further pressure on builder margins and project viability. So why does this matter? Because if projects become less profitable, fewer projects get built. And if fewer homes get built, the supply shortage worsens. So even though demand is cooling, we still don't have enough stock entering the market. That's why prices haven't rolled over. And that's also why rents remain under pressure. Let's talk rental market. So rental markets haven't materially loosened this month either. Vacancy rates remain historically tight nationally, with many markets still sitting around or below structurally balanced levels. Broader market commentary continues to cite ongoing rental shortages as one of the strongest supports for housing demand. That matters because rental tightness supports investor yields, investor demand, and price floors. So while owner-occupiers may slow down, investors still have incentive to remain active where yields make sense. This is especially important because many investors are now entering markets based less on speculation and more on cash flow resilience. But there is another pressure building here, and that's sentiment. Consumer confidence around housing has softened materially over the last few weeks. Analysts are describing the current environment as a defining period for the housing market, with affordability pressures, rising rates, and macro uncertainty all weighing on sentiment. That doesn't automatically mean a downturn, but it does mean momentum becomes harder to sustain because housing markets don't just move on fundamentals, they move on psychology. And right now, psychology is shifting from buy before prices rise again to wait and see what happens next. That shift matters enormously because hesitation slows the momentum before fundamentals break. Now, here's a major contradiction I mentioned earlier. See, the Australian market is currently being pulled in two opposite directions. On one side, we have weaker borrowing power, softer auction demand, failing confidence, and rising affordability pressure. On the other side, we have undersupply, construction bottlenecks, tight rentals, and ongoing structural housing shortages. And that creates a market where demand is weakening, but not enough to overpower supply shortages. That is why we're not seeing a crash. We're seeing friction. We're seeing selectivity. We're seeing fragmentation. And this is what investors need to understand. There is no longer a broad-based everything goes up market. This is becoming a market where good assets outperform average ones. The fundamentals, they matter more, and strategy matters more than timing. Because when both bullish and bear forces exist at once, the winners become more selective. Let's talk about what didn't change. Let's reduce the noise for a second and talk about, firstly, Australia's structural housing shortage did not improve. There's still no evidence supply is catching up meaningfully with demand. Second, rental markets did not materially loosen. Vacancy remains tight, rental pressure persists nationally. Third, there's been no major lending policy relaxation from the banks or APRA. So credit remains relatively tight and searchability buffers remain unchanged. Fourth, no major new federal housing reform was announced. So why does this matter? Because sometimes the most important insight is understanding that despite all the headlines, the structural foundations underneath this market remains largely the same. And that means the broader long-term pressure hasn't disappeared. It's just being temporarily offset by higher rates. So heading into next month, here's what investors should be watching closely. First, watch auction clearance rates. If they remain below mid-50s consistently, that could confirm a broader buyer weakness is building. Second, watch the RBA commentary and inflation data, because if inflation remains sticky, further hikes remain on the table. Third, watch construction and approvals commentary. Any worsening in project viability will further pressure long-term supply. And fourth, watch the sentiment. Because if buyers move from cautious to fearful, momentum can slow quickly. If you found this breakdown helpful and you appreciate property commentary that actually looks deeper than the headlines, make sure you like the video, subscribe, and let me know in the comments, what are you seeing in your local market right now? Because bridging the ground sentiment is often where the earliest changes appear first. And if you're trying to work out how to navigate the market properly, whether that's buying your first investment, scaling your portfolio, or just understanding where the opportunities actually are in a changing environment, book in a strategy call with our team at Investor. Or if you want a deeper monthly breakdown, research, and strategic support, check out the Investor membership, where we help investors build clarity, structure, and confidence in every decision they make. Because in the markets like this, information alone isn't enough. You need the right strategy behind it.